Choosing the right investment strategy can be overwhelming for beginners. So in this video, we're breaking down the top 5 portfolio strategies to help you navigate the sea of options and find the best fit for your financial goals. But first of all, what the heck is a portfolio strategy and why does it matter so much? A portfolio strategy is essentially a plan for how you allocate your investments across different types of assets like stocks, bonds, and cash. Without a plan, it's easy to get lost or take unnecessary risks that can hurt you in the long term. When I had no financial education and only a vague idea of what investing was, I thought that all I had to do was pick 1, 2, or 3 companies and buy their stocks. I figured that once I had those stocks, the work was done. And this is a common mistake many beginners make. What you want to do instead of picking a few stocks and hoping for the best is to first ask yourself these 5 key questions. What are your financial goals? What are you investing for? What is your time frame? How long do you plan to keep your money invested? Short-term time frames require a different approach than long-term ones. How much risk are you comfortable with? Can you handle the big ups and downs in the market, or do you prefer more stability? How much do you know about investing? Because your knowledge level can affect which strategy is best for you. And how involved do you want to be in managing your investments? Do you want to set it and forget it, or are you interested in actively managing your portfolio? Answering these questions can help you find a plan that fits your personal situation. Now let's dive into the 5 portfolio strategies. The 60-40 portfolio is one of the most well-known and widely used investment strategies because it has a balanced mix that consists of allocating 60% of your investment funds to stocks and 40% to bonds. This strategy works best for investors with a medium to long-term time frame. So it's a good fit if your goals include saving for retirement or building a nest egg for the future. The goal of a portfolio like this is to balance risk and reward. By investing 60% in stocks, you are exposed to the potential for higher returns but also higher volatility. Now, the 40% in bonds helps mitigate this risk by providing more stable and predictable returns, making it suitable for investors who can tolerate some market ups and downs but still want a level of safety. You don't need to be an expert to use the 60-40 portfolio effectively. It's a relatively simple strategy that doesn't require constant monitoring or complex financial knowledge. However, you do need to understand the basics of stocks and bonds and how they interact. This portfolio is also a good choice for investors who prefer a set it and forget it approach because you can set it up and make occasional adjustments such as rebalancing once a year to maintain the 60-40 allocation. For example, let's say you have $10,000 to invest. In a 60-40 portfolio, you would allocate $6,000 to stocks and $4,000 to bonds. For the stocks portion, you might choose a broad-based index fund, and for the bond portion, a mix of government and high-quality corporate bonds. The next strategy is the growth portfolio, which focuses primarily on investments that are expected to grow at an above average rate compared to other assets. This typically means a heavy allocation to stocks, specifically in sectors like technology, healthcare, and other high growth industries. This strategy also works best for investors with a long-term time frame, generally 10 years or more, because you have the time to ride out market fluctuations. Since the growth portfolio relies heavily on stocks, typically 80% to 100% of the portfolio, it is riskier and suitable for investors who are comfortable taking on such risk in exchange for the possibility of higher returns. You don't necessarily need to be an expert to use the growth portfolio, but having some understanding of the stock market and the ability to identify growth sectors can be beneficial. Many mutual funds and ETFs that are growth focused can help simplify this process by providing diversified exposure to high growth companies. Therefore, this portfolio can be managed with varying levels of involvement. If you prefer a more hands-off approach, you can invest in such mutual funds or ETFs. And for those who enjoy being actively involved, you can pick individual stocks and adjust the portfolio as needed. So to summarize, for example, if you have $10,000 to invest, you might allocate $8,000 to $10,000 to stocks, focusing on sectors with high growth potential such as technology and healthcare. You could choose individual stocks of such companies or invest in funds that provide exposure to a basket of such stocks. The income portfolio is designed to prioritize generating regular income for the investor. This is typically achieved through investments in dividend-paying stocks, bonds, real estate investment trusts, also known as REITs, and other income-producing assets. This strategy works best for investors with a shorter to medium-term time frame or those who need regular income, such as individuals approaching retirement who want to ensure a stable source of funds to cover living expenses. Since the income portfolio focuses on generating steady income, it typically involves lower risk compared to growth-oriented portfolios. Due to its stability and consistent returns, it is more suitable for conservative investors who prefer less volatility. To use this strategy effectively, you need to have a basic knowledge of income generating stocks and bonds, but there are also many mutual funds and ETFs designed to provide income streams, which can simplify the process and make it easier to manage your portfolio. As you probably noticed by now, most portfolio strategies can be managed with varying levels of involvement. You can choose the mutual funds route, or you can do it on your own and adjust your portfolio as you see fit. For instance, with $10,000 to invest, you might allocate your funds by investing 40% or $4,000 in high quality, large companies with a history of consistent dividend payments, such as companies in the utilities or consumer staple industries. Another 40% or $4,000 would go to a mix of government bonds and high-quality corporate bonds to provide stable interest income, and the remaining 20% or $2,000 would be invested in REITs to gain exposure to income-generating real estate assets. Moving on, we have the balanced portfolio. This strategy is designed to provide a mix of growth and income by allocating investments across asset classes, such as stocks, bonds, and sometimes real estate or commodities. A typical portfolio might allocate 50% to stocks and 50% to bonds. This means that with $10,000 to invest, you would put $5,000 into a broad-based stock index fund to capture growth across the market, and the other $5,000 into a mix of government and high-quality corporate bonds for income and stability. For additional diversification, you could also allocate 10% of your portfolio to REITs. Investors with a moderate risk tolerance and a medium to long-term time frame might prefer this approach to investing as it reduces the impact of market volatility. This strategy is straightforward and easy to manage, making it accessible to most investors, and many mutual funds and ETFs again offer balanced options which automatically maintain this allocation for you, simplifying the investment process even further. And last but not least, we have the target date portfolio. This is an automatic portfolio that adjusts the asset allocation as you approach a specific target date, which is often used for retirement. It starts with a higher concentration on stocks for growth and gradually shifts to bonds and other stable investments as you approach the target date. For example, if you plan to retire in 20 years, you might choose a target date 2044 fund. This is a complete hands-off approach to managing your investments, as the portfolio managers select the investments and adjust the allocations for you. However, because it is actively managed, these funds tend to have higher fees compared to other investment strategies we have discussed. Initially, a target date 2044 fund might allocate 80% to stocks, and this includes a diversified mix of large, mid-size, and international companies, and 20% to bonds consisting of a mix of government and corporate bonds. As you approach the year 2044, the allocation might shift to 40% or even lower in stocks to reduce exposure to market volatility, and 60% or higher in bonds and other low-risk assets to increase stability and income generation. Now, an important note for all portfolio strategies we have discussed, except for the target date portfolio, which is automatic. Over time, the performance of different asset classes will vary. This means that the proportions of stocks, bonds, and other investments you have in your portfolio can drift away from your target allocation. And to keep your portfolio aligned with your financial goals, it needs to be rebalanced regularly. There are a few ways to rebalance your portfolio, but one of the most effective methods is to invest more in the asset classes that have fallen below your allocation. This way, there is no need to sell investments which can incur taxes or other costs. For example, let's say you have a balanced portfolio with a target allocation of 50% stocks and 50% bonds. Over time, due to market performance, your portfolio drifts to 60% stocks and 40% bonds. To rebalance, you need to identify the current proportions of your investments and determine the shortfall. In this case, you need more bonds to get back to the 50-50 target. So instead of selling some of your stocks, you can direct new investment money into bonds. So those were the top 5 portfolio strategies, each with unique benefits to different financial goals, risk tolerance, and time frames. Thanks for watching and see you in the next one. Bye.